You know, when people talk about Australian property markets, Sydney and Melbourne always hog the spotlight. But quietly, Brisbane's been making one of the strongest plays in the country. Let me put it this way. If you had bought the median Brisbane property just 5 years ago, you'd be up more than $250,000 today. And that's not speculation, that's real data. And despite affordability tightening across the country, Brisbane has been able to attract buyers, investors, and migrants at all levels in ways that the other capital cities simply haven't been able to match. Now, here's where it gets interesting. Brisbane today sits at a median price of $875,000. That's up 8% in the last 12 months alone. And momentum, it's keeping up because in the last quarter alone, Brisbane's up 3%. And with the Olympics just 7 years away, infrastructure spend accelerating, and interstate migration still flowing up north, Brisbane isn't just keeping up, it's setting the pace in ways that Melbourne and Sydney just simply can't keep up with. So in this video, I'm going to touch on where Brisbane sits today, what the demand and supply dynamics look like on the ground, and I'll also go through my scenarios for the next 12 months. Now, if you stick right till the very end, I'm going to touch on where I'd be focusing on if I was investing into Brisbane today. Guys, my name's Josh. I'm from DataEdge Property, and I help everyday Australians grow their wealth in the Australian property market using data. Data that's accessible to absolutely everyone. And if you get value out of today's video, make sure you smash the like button. With that said, let's jump into where Brisbane sits right now. So I'll bring up this chart from Cotality, which shows the Brisbane rate of growth across the last month, quarter, and year. And you can see that the rate of growth across the last month was 1.2% and 3% for the last quarter. And when you compare the annual rates of growth of 8% in Brisbane to the likes of Sydney at 4.8% and Melbourne at 3.2%, you can see that Brisbane's now entrenched as one of the top performing capital cities. Now, if you look at the more recent Cotality Daily Home Index, you can see that that quarterly rate of growth isn't slowing. In fact, we're at 3.1% today. Now, if you just annualize that out over the next 12 months, Brisbane is growing at 12% per annum, which is an incredibly quick rate of growth, second only to Perth right now. But that's the situation right now. We also have to consider the longer term trend, and Brisbane has effectively doubled since 2012. And although it hasn't hit the levels of Sydney, it is definitely approaching uncomfortable levels of affordability. Now, I want to bring up these two charts from the most recent affordability report from ANZ. Now, this first one shows us the percentage of household income required to service a new mortgage. And you can see that in Brisbane, we're now sitting at above 50%. And what that means is that over half of a household's income is going towards servicing a mortgage, which is a whopping number. Typically, if we look at historical levels, anywhere above 40%, and it gets pretty uncomfortable. 50% is pretty high, but you have places like Sydney where we're now at 60%. So although I'm expecting for that percentage as a whole to go higher and higher over time, it certainly is approaching a affordability cap. Now, this second chart that you can see shows us the dwelling value to income ratio. And again, to give you a bit of context around when this gets to uncomfortable levels, typically when it gets above 8, so when the value of the median dwelling is 8 times a household's income, that's when things get pretty uncomfortable and households reach affordability caps. Now, if we look at Brisbane today, it's sitting at 8.2. So these are the things that I would be conscious of if I was investing into Brisbane today. It's certainly not the affordable market that it was a short time ago. Now, the other thing that we're seeing is regional spillover, particularly into southeast Queensland. So areas like Ipswich, Logan, Moreton Bay, the Gold Coast, they're all seeing similar levels of growth. And that's been fueled by population inflows and affordability relative to Brisbane. But even those markets are getting pretty toppy right now. But here's the real question. Why is Brisbane holding so strong when other capitals are faltering. To look at that, we need to look at demand versus supply. And to do that, let's talk about the supply side of the equation by talking about listings. So I'll bring up this chart from Cotality, which shows us the number of new listings and the change from the equivalent period last year. And you can see that Brisbane new listings are down 16% relative to last year. If we look at total listings and how they've changed against last year, well, we're down 16% as well. So what that tells me is that we're seeing a listings crunch where there are less listings than the same period last year. And that's thousands of homes that aren't hitting the market. Sellers know that they'll get growth if they hold on to their properties. So supply is drying up and that squeezes buyers even further. Now, let's have a look at days on market. So we're now sitting at 22, and that's definitely higher than where we were last year at 16. But that said, that's still well below decade averages of 50 to 60 days. So while buyers are being a touch more cautious, the market is still moving quickly. So the way I would think about it is it's slower than red hot, but nowhere near cold. Well, let's have a look at vendor discounting. And for those who don't know what that is, effectively, if you compare the sale price to what was advertised initially, it's that discount that a vendor has to provide to a buyer to sell the property. And currently that's sitting at negative 2.7%, which really isn't big. And what that tells me is that sellers are barely needing to budge on price. And what that also tells you is that demand is still chasing supply. Now, the next thing I wanted to touch on was sales volumes. So these are down 3.2% relative to last year. And what this tells us is that despite listings being materially down compared to the same period last year, the levels of sales has actually remained relatively constant despite this constrained supply. So buyers are still very active in this market. And when sales and listings look like this, you know that the next pressure point is always going to be rents. Well, let's have a look at the following chart from Cotality, which shows us the annual change in rents relative to same period last year. And we can see that for Brisbane, rents are up 5.3% per annum, which although that's slower than the double-digit rate of growth we've seen in prior years, it's still quite healthy, especially when you compare that to some of the other markets nationally. So effectively, Brisbane's rental market, it really hasn't had much of a breather in recent years, and tenants, they're still getting stretched pretty thin. Well, what about vacancy rates? To be honest, these are still hovering at record lows. If we bring up this chart from SQM Research, which is probably the most accurate data when it comes to vacancy rates, we can see that we are just a smidge above 0.8%. And for those that don't know much about vacancy rates, if you're under 2%, it's a super hot market. Anything under 1% and rentals are effectively moving like hotcakes. And when you have a vacancy rate that's this low, it means that even with rent hikes, tenants have nowhere else to go. So really, it wouldn't surprise me if that rate of rental growth continues to go higher. And to be honest, if you've seen the most recent inflation data, it wouldn't surprise me at all if that were to happen. Well, what about yields? Well, we're currently sitting at 3.6 gross rental yield, which, look, definitely that's some significant compression in rental yields compared to prior years. You know, if you had gotten into the Brisbane market super earlier, you could have got yourself a 5, even a 6% yield. So that's definitely come down. But in isolation, that doesn't really tell us much. We need to see how that yield has actually shifted over time to draw an accurate insight from. With that said, let me pull up this other chart from SQM Research, which shows exactly that. And it shows us that the rental yield in Brisbane is currently at its lowest level in over a decade. And this could potentially turn some investors off the market, which will result in less rental stock and actually place further upward pressure on rents. Again, all of this could potentially lead into further rental growth in the short to medium term. Now, what about investor demand? Well, lending in Queensland is up 39% versus the decade average, and that's huge. Investors are seeing Brisbane and Queensland more broadly as the balance of yield, growth, and affordability. better than Melbourne, and cheaper than Sydney. And this is why due diligence matters. With so much investor heat coming into the market, it's easy to overpay or just buy the wrong asset. If you want the exact framework that I use to separate smart buys from traps, grab my free property due diligence checklist in the description box below. And with that said, there's actually one more piece that could tip the scales over the next year, and that's credit and interest rates. So what is happening with credit and rates at the moment? Well, the RBA cash rate, it's currently sitting at 3.6% in August. Now, the futures market is currently pricing in between 1 and 2 rate hikes over the next 12 months. So effectively what that means is that the average buyer in Australia is likely to have increased borrowing power across the short to medium term. Now, in terms of finance approvals, Queensland currently ranks second nationally for housing growth. And what that means is that the credit tap is certainly opening and Queensland is drinking faster than most of the other capitals. Now, if you look at this chart from the most recent State of States report, you can see that the rate of credit growth is sitting at 39% when it comes to housing finance, second only to Western Australia. And with new schemes coming in from the government, like the first home buyer incentives and the most recent 5% government guaranteed deposit scheme for first home buyers, that's going to feed demand in the entry-level markets. And this demand is going to create urgency. And if you want a full breakdown of how that 5% government guaranteed deposit scheme works, who qualifies, what the limits are, and what it likely means for house prices, I did a whole video on it. So make sure you check that out right after this one because it ties directly into why Brisbane still has room left to run. So let's pull all of this together. What does the next 12 months look like for Brisbane property? Well, as always, I'll do my base case, I'll do my upside case, and then I'll do my downside scenario. Let's start with the base case. So I'm saying that in the most likely scenario, Brisbane over the next 12 months will grow between 6 to 8%. Now, what are the assumptions behind that? Firstly, I want to see listings remain very tight. So I wouldn't want to see a listing surge into spring and into the new year. Now, I'm not saying that listings need to decrease for this to happen, but I'd like to see for listings to remain steady throughout the year. Obviously, you'll still have seasonal peaks and troughs, but as a whole, I want to see listings remain steady. Secondly, population growth needs to continue. So Queensland currently has the third quickest population growth rate anywhere in the country at 1.86%. I would want to see that continue to be sustained over the next 12 months and into the future, which likely will be the case. And that ties into my third point is that the Olympics is going to continue to add confidence, and as a result, infrastructure spend is going to continue to create jobs and attract that interstate migration, which is then going to fuel into that population growth. So again, that's my most likely scenario. What about the upside case? Well, in that scenario, things will likely grow between 9 to 11%. Now, what would need to happen for that to occur? Well, supply would need to continue to reduce into FY26. So I just said relative to last year, listings are down 16%. Well, I would want to see that figure go down even further. Do I think that's likely? Probably not, but at the same time, do I think that listings are going to increase? Probably not either. Hence why I think that things will actually stay quite stable over the next 12 months from listings, which means that there's still going to be that listing crunch. Secondly, for the upside scenario to transpire, investors would need to pile in and credit would need to loosen further. So we'd need to see at a minimum 2 more rate cuts from the RBA, if not more. Again, do I see that as likely? Well, based on the current data, doesn't appear to be the case, but you never know. Who knows? And under this upside scenario, well, Brisbane would certainly lead the capital cities up there with Perth. Now, the downside scenario, and to be honest, given the most recent data that I've been looking at, I'm not seeing this as particularly likely, especially with these new government schemes coming in October. I'm saying 2 to 4%. Now, what would need to happen for that to occur? Well, unemployment would need to rise and construction completions would need to spike unexpectedly. And as a result, you'd see growth begin to moderate. Now, I'd love to hear your take. Which of these three scenarios do you think is most likely to occur for Brisbane over the next 12 months? My base case, my upside case, or my downside case? Make sure you drop it in the comments below. I'm keen to hear where your expectations currently sit. So with that said, what are the key things that I'd be watching at the moment? Well, firstly, again, it's that listing story. Will spring listings rebound or will they continue to remain scarce? Secondly, continue to monitor that Olympics infrastructure spend. You want to be looking at the timing and the delivery because again, it's those projects that are going to drive job growth and it's going to drive increased population into Queensland and Brisbane specifically. Lastly, make sure you're keeping an eye on rental affordability because at some point, tenants will begin to break and that rate of rental growth will begin to moderate. So with that said, if you're investing into Brisbane today, where should you actually be focusing? Well, I would be focusing on the following 4 key areas. Firstly, it'd be the mid-tier family suburbs with amenity. So anything that's relatively centrally located, near good schools, near transport nodes, jobs. So I wanted to bring up this chart from Cotality, which shows you the rate of growth in Brisbane in the various price pockets. And you can see straight away that the lowest 25% and the middle 50% of values have been growing the strongest across the last 12 months, whereas the highest 25% have been lagging. And this is something to keep in mind if you're investing into Brisbane today, because what this tells me is that it's the affordable areas that are still driving the market right now. Those super expensive, pricey areas are already pretty toppy. So I'd be cautious going into those areas at this point in the market. Now, the second area that I'd be focusing on is the prestige adjacent areas. So not your blue chip areas like Camp Hill or Coorparoo or Paddington or Ascot or Hamilton, but look at the suburbs that are a little bit further away, which people buy when they can't get into those more affluent areas that they actually want to live in due to affordability constraints. Because at the end of the day, you're going to see ripple effect into those areas, and that's where the depth in the market is going to build next. Because the last thing you want to be doing is investing into areas where prices have already doubled by more than 100% over the last decade, because there's likely going to be limited upside in the short and medium term ahead. So the last thing that I'd be focusing on is value add plays. So any property that has subdivision or renovation or development potential and making sure that zoning allows for those things in the future. Now, the reason for that is because Brisbane has already grown so much over the last decade. Again, you can't rely on the market to do the heavy lifting anymore. So again, if you're getting in at this point in the market, you need to be able to manufacture growth yourself in the event that the market cools from here. Now, if you're finding this breakdown useful, I'd appreciate if you hit the like button down below. It'll help more Aussies find data-driven content just like this. And make sure you subscribe as well, because I'll have more Outlook videos just like this out in the near future, including suburb deep dives. So with that said, Brisbane's market absolutely has stamina. Record prices, scarce listings, and the Olympics ahead make it one of the most compelling cities anywhere in the country right now. I'm expecting mid to high single-digit growth in the next year ahead, with upside if supply doesn't bounce back. Now, if you've stayed this far, thanks for sticking around and supporting the channel. I really appreciate it. If you want to go deeper on deal analysis, again, I've got my completely free asset due diligence checklist in the description box down below. And don't forget to subscribe for more Brisbane and national market updates, including deep dive analysis, which I'll have out in the near future. Thanks for watching, guys. I'll see you in the next one.